Greetings from 3Edge Asset Management, and welcome to the 3Edge Quarterly Webinar for the second quarter of 2024. I'm Fritz, Folts, the Chief Investment Strategist here at 3Edge, and I'm joined here once again today by Steve Cucchiaro, the CEO and Chief Investment Officer here at 3Edge Asset Management. Today, Steve and I will take a look back and review the second quarter of 2024, and as well as the first 6 months of this year. And then Steve will share our current outlook for the global capital markets. As we do each quarter, we will begin with a few firm highlights. As a reminder, 3Edge is a tactical multi-asset investment firm. We currently manage approximately $1.8 billion in assets, and our team here at 3Edge has continued to grow, and we've expanded our geographic reach by establishing a presence in Wilmington, North Carolina, and Denver, Colorado, in addition to our offices in Boston, Massachusetts, Naples, Florida, and Los Angeles, California. In response to client demand, we have continued to build out our suite of available investment solutions. Beyond our core 3Edge active multi-asset strategies, we now have a full line of equity-only strategies, including global, international, and U.S. equities. We also offer a multi-asset income-focused strategy, the 3Edge Income Plus, which seeks income opportunities around the world and across a variety of asset classes. While the strategy seeks attractive yield opportunities, we still pay careful attention to risk, making tactical changes based on our proprietary 3Edge global capital markets model. As with our other 3Edge strategies, investment exposure is achieved primarily through the use of index exchange traded funds, or ETFs. Also, in response to client interest, we now offer a suite of values-based investment strategies through our ESG and faith-based 3Edge investment solutions. Our TAMP assets continue to grow, and we're staying in touch with the independent RIAs that use our strategies by attending major conferences. In fact, we'll be attending 2 upcoming conferences in August, both the Cambridge Ignite and the Atria Engage conference. And so for advisors who may be listening to today's webinar, feel free to stop by and say hello to us at these upcoming conferences. We also continue to focus developing our thought leadership capabilities through our 3Edge video series with our weekly 3Edge Week in Review and our monthly 3Edge View from the Edge. And our viewership and subscriber base for our YouTube videos continues to grow, and we continue to hear good things from our listeners. And we believe that when it comes to investing, knowledge is power, and that is why we continue to create these short informational videos for our clients. So now let's look at what transpired in the global capital markets in the second quarter, as well as over the course of the first half of this year. So this chart, if you look at it, is divided into 2 parts. On the left, we can see the investment performance of the major asset classes in the second quarter. And on the right is the performance of the major asset classes over the first 6 months of 2024. So let's focus on the left side here of the chart, and we see that, as was the case in the first quarter of this year, all major asset classes had positive performance in Q2, with the exception of U.S. Treasuries, which declined slightly by 0.2% during the second quarter. And the best performing major asset class in the second quarter was gold, which benefited from a variety of factors, including its capacity to serve as a hedge in times of geopolitical uncertainty. If we shift our attention then to the right side of the chart, we see investment performance of the major asset classes over the first 6 months of the year. And as was the case in the last 3 months, for the first 6 months of the year, gold has been the best performing asset class, followed by global equities, as investor psychology, momentum, and trend following have continued to power equity markets higher. We also can see from the chart from the right the struggles that the bond market has continued to experience through the first half of this year. 7 to 10-year U.S. Treasuries still in negative territory this year, approximately down about 1.5% year to date. And lastly, in the first 6 months of the year, we can see that the commodities markets are rather quietly up, approaching a 5% year to date return, and cash is also earning positive returns here in 2024. Cash equivalent investments in the first 6 months up 2.5%. In terms of investment performance, we've shown this slide in the past, and I think it's just as relevant today. The point of the slide is to seek to provide some perspective in terms of the performance, particularly of the S&P and the NASDAQ after the first 6 months of 2024, which again, thanks to investor psychology and momentum and a small handful of mega cap tech stocks, have had a strong first 6 months of 2024. However, if we were to look back over a slightly longer time frame, in this case back to January of 2022, which would include the downturn in equities in that year of 2022, we see that from January 1, 2022, up through the first half of this year, the S&P is up, but just over 7%. And that gain is less than half of the gains thus far in 24 for the S&P 500. And we see just how dramatic the struggles in the bond market have been, with the aggregate bond index down minus 3.6%, the 7 to 10 year U.S. Treasuries down over 5.5% over this slightly longer period of time. And lastly, if we look at the bottom three rows of the chart, we see that gold is the best performing asset class over this period, with a return just shy of 10%, while commodities have returned over 6.5%, and cash has earned over 3.6%. And so the point of the chart is simply to show that if you step back a bit and have a slightly longer term perspective, you gain a bit more realistic understanding of the performance in the U.S. equity markets. And we also observe that it can make sense to expand one's horizon beyond just stocks and bonds and consider a more diversified multi-asset approach to investing. So now let's look at the performance of our core three-edge strategies through the second quarter of 2024, as well as we have 1 year and 5 year and since inception returns in the slide. The slide shows the performance of the three core strategies going from left to right: three-edge conservative, total return, and growth. In the fourth line down, the table shows the line charts that each of the three core strategies have outperformed their benchmarks in the second quarter of the year. And then if we go back to the top and look at the line charts above the tables, they show performance of these three-edge strategies versus their benchmarks since inception. So sticking with the line charts, we see that since inception, three-edge conservative has slightly underperformed its target risk benchmark. However, if we look at the second line in the table for conservative, we see that the maximum drawdown of three-edge conservative is less than 1/3 of the maximum drawdown of its benchmark. The maximum drawdown of conservative is just barely over 5%, while the maximum drawdown of the benchmark is down over 17%. And we would not be willing to accept a decline of over 17% in this strategy. So we are willing to forego at least a portion of the benchmark returns in order to keep our clients safe. In the middle chart, we see that three-edge total return has outperformed its benchmark since inception, and importantly, it has done so with less than half the risk, again, as measured by maximum drawdown. Then lastly, on the far right, we see three-edge growth, which since inception has underperformed its benchmark, but again, and importantly, the maximum drawdown for three-edge growth is just about 1/2 of its benchmark. In total, these charts serve to illustrate what we always set out to do with three-edge, and that is to provide the best possible investment returns while taking the least amount of risk possible. Or, as we often say, what we seek to do is generate attractive risk-adjusted returns over full market cycles. Now we'll just take a quick look at a chart that shows information, some of our other three-edge investment solutions: three-edge Income Plus, three-edge Global Equity, and three-edge International Equity. Income Plus is driven by the same three-edge proprietary research model, which drives all of our investment solutions and seeks income generation with an active tactical approach and broad asset diversification. And it seeks to balance yield with risk and return. The two other strategies on the slide: three-edge Global Equity, which is up over 10% year to date, and three-edge International Equity, which has actually outperformed its benchmark by almost 300 basis points since inception. Again, these strategies are examples of our expanding investment solution offerings. One last investment performance slide I'd like to show shows the performance of the three-edge conservative strategy versus its benchmark, which is versus the S&P 500 aggregate bond index and against the municipal bond index. And as we can see, this chart shows how since inception, three-edge conservative has not only outperformed the aggregate bond and municipal bond indices, but it has done so with much less risk as measured by maximum drawdown. And this is why so many of the independent RIA firms and advisors that we work with utilize the three-edge conservative strategy as a substitute for core bonds in their clients' overall investable assets in combination with other strategies in mixed model portfolios. In this last slide, I just want to point out how with the expansion of our three-edge investment offerings, clients are now diversifying among and combining various three-edge strategies to fine-tune their asset allocation to suit their specific risk and return goals. The example in this chart, on the left, we see a combination of a strategy with 50% three-edge U.S. equity and 50% three-edge total return. The middle chart shows a combination of 50% three-edge total return combined with 25% in three-edge income plus and 25% in three-edge U.S. equity. And then the last part shown on the right shows a different combination, 50% in three-edge total return, 25% in three-edge U.S. equity, 20% in global equity, and includes a 5% position in our three-edge crypto plus strategy. The combinations and blending of the three-edge strategies provide an elegant blended portfolio of a client's investable assets that is fine-tuned to each individual client's risk and return goals. And importantly, here at Three Edge, we have the modeling firepower to actively assist in creating these blended combinations of three edge strategies. So with that, I will hand things over to Steve, who will provide our current market outlook. And so, Steve, I will turn things over to you. Take it away.
Well, thank you, Fritz. I'd like to begin by talking about the focus of our research, which is to identify the true cause and effect relationships that drive the markets. And starting with the S&P 500 index of U.S. stocks, there are some positive forces that the model has identified, and there are some negative forces. On the positive side, the number one positive factor that's helping drive the markets, and you referred to it, is trend following price momentum. The idea that many investors look in the short term, in the recent past, extrapolate the trend. They want to ride that trend and hope that it continues to extrapolate indefinitely. And when they buy into the market, that causes the price to go higher. That draws more investors in. And it's a self-reinforcing feedback loop. It's a virtuous cycle, and it can help propel a market to continuously go up for some extended period of time. And of all the factors that are positive, that the model has identified, that's the most positive factor driving the markets. Second is rising corporate earnings, not necessarily the level of corporate earnings, but the rate of change. Third, built into some of the market signals and interest rate signals is the idea of an increasing prospect of Fed rate cuts. Fourth is that as bonds went up to 5% at the 10-year Treasury level and then came back down to around 4.2%. In the short term, that's been a positive factor. And then five, we have tight credit spreads, meaning the difference between a bond yield for a less quality company versus the bond yield for a super safe Treasury at a similar duration. Those spreads are very tight. That indicates continued faith that the economy is still strong. So those are the positive market forces that have been picked up by the model. But on the negative side, we've got the measure of extreme overvaluation, where some measures of valuation are historically as extreme as they ever get. Second, we still have an inverted yield curve, which is higher short-term rates versus long-term rates. That's not normal. That's not natural. And every time in the last several decades that's happened, it's resulted in a bear market and a recession, but after a very long lag. So a lot of people often say, well, the yield curves don't matter anymore. Then after that long delay, they do kick in. And that contributes to the prospect of an economic slowdown. In terms of profit margins, the profit margin, or the income over sales of the S&P 500 companies, is as wide as it's ever been in history, with one exception. That one exception was the summer of 1929, a bit of an auspicious time. And profit margins that are abnormally high or low tend to mean revert, meaning that they don't last permanently high forever. They don't last permanently low forever. And the normal natural forces tend to mean revert. So it's a vulnerability. Then 5, the rally has been so extended over the last several months in the US market that the market is especially vulnerable to a black swan or an event that might be hard to predict that comes out of the blue, that can take a market that's only gone one direction very steadily for many months in the opposite direction. So as an example of overvaluation, let's just look first at the current year. We know over any long-term period that the price per share of a stock, or in this case, the S&P 500 index, goes up at the same rate as the earnings per share and the sales per share. These are all linked. They all go up at the same rate over any long period of time. But at any short period of time, it's a sign that if investors are overly exuberant and overly excited about the market, they might pay a higher price than what is warranted by the fundamentals, and you see the blue line rise. Or conversely, if they're extra panicky and fearful, you might see the blue line fall below the fundamentals as an indication of too much fear and a potential undervaluation of the market. So here we see investors got way ahead of themselves in terms of driving the prices far in advance of the growth in sales and profits. So if we look at long-term picture, not only has it been happening this year, but we see that the gap between the price per share, the blue line, and the sales and earnings per share, which are the gray and orange lines, is very, very wide. And only 2 times has it been this wide in history. And one was the summer of 1929. That resulted in an over 80% decline in the US stock market. The second was early 2000, and that resulted in an over 80% decline in tech stocks and roughly a 45% decline in US stocks. So while there's nothing in this chart that says we have to have a decline start tomorrow, it would be irresponsible to think, and maybe malpractice to think, that you should be complacent and not to worry about valuation, because we know that at some point these lines have to converge, and it's much more likely that the price per share comes back down to earth. So we do believe we are in a stock market bubble. Alan Greenspan once said that it's really hard to know when you're in a bubble until after it's burst, and then it's easy to look back and notice you're in a bubble, and then you just have to pick up the pieces. But based on our analogies in history, we would say that this AI bubble that we're in, with NVIDIA as the poster child or the iconic stock of the current bubble, is very much like history. We are now in an AI revolution. It's very clear that AI will generate tremendous productivity gains over time. But like before, investors get so exuberant that they run in advance of the actual fundamentals. Same thing happened in the 1990s with the tech stock bubble, and Cisco was the NVIDIA of its day. In the roaring 1920s, we had the new technology of electricity and automobiles and radio and mass production. RCA was the NVIDIA of its day. In the 1870s, it was railroads. In the 1720s, it was the South Sea Company. These are all famous bubbles, all following similar patterns, all lasting far longer than logic might suggest, but none of them lasting indefinitely. If we want to compare on a scale, NVIDIA is the green line, and it's grown tremendously over time. If we overlay that with Cisco and RCA from previous bubbles, we see that there may be even more room for NVIDIA to continue to climb. But the reality is that it's not destiny that it needs to climb as high as those past bubbles. Rather, it just depends on how long it takes before a catalyst comes along and switches the polarity from a big rise to a big fall. This year, the US stock market is getting a lot of attention as the one asset class is performing well, but it's not the only one. If we look here, we see this year, the US stock market in blue has done very well. but so hasn't Japan. So hasn't India. So hasn't gold. And in fact, this chart ends on June 30th. And since then, gold has actually risen and surpassed US stocks. And so the good news is that for 3Edge clients, we have investments not only in US stocks, but also in Japanese stocks, in India stocks, and in gold. So we're benefiting from the gains this year, but in a very diversified manner. I want to talk about the potential for what I might think of as a great rotation. And several days ago, there was the first sign where, uncharacteristically, the large tech stocks that have been leading this rally all fell. And at the same time, the laggards, which are the small cap stocks or the value stocks, which had fallen far behind, have had a tremendous rise. So we think of this as a great rotation pivot. And there are a few reasons why this happened. And understanding those reasons will help us assess whether this is just a very short-term blip in a pattern that will continue, or is this a major turning point in the markets we need to take seriously? We need to adjust the portfolios for. So that's very much an active discussion right now in our investment committee and in our research. So one change is that the Federal Reserve Board has been much more forthcoming, sending signals that it's getting closer and closer to a rate cut. And that would present the prospect for easier financial conditions. It might preempt a possible recession by not letting the rate stay higher for longer, but it also could prolong sticky inflation. So the Fed has a tough decision to make, but they are indicating that rate cuts are about to happen sooner rather than later. Secondly, politics are involved, and the market has been making an assessment based on its behavior that it's more likely now than before that the Republicans may win the election in November. So there's more scrutiny on some of those economic policies. And some of those policies include favoring lower tax rates, favoring lower interest rates, favoring higher tariffs, and favoring a weaker dollar. The only thing is that when you put it all together, those are the elements or aspects of an economic policy that usually lead to higher inflation. So it remains to be seen how this plays out. But as investors, we need to be cautious and realize that inflation might come down temporarily, but for these other reasons, we need to have hedges against the possibility of inflation rising again. Secondly, reading between the tea leaves, the market has observed that some of the policy statements are favoring Main Street versus Wall Street. That's another way of saying favoring small versus large corporations. And frankly, with the Fed cuts, maybe sooner rather than later, a lowering of interest rate does favor small caps, which are more dependent on borrowing money, versus the large cap growth stocks that make so much money they don't need to borrow money. They're not as dependent on where the interest rates are. And then finally, we saw more recently comments out of the Republican policy that says that they might be less willing to defend Taiwan. And that caused a shudder in the semiconductor industry, and that caused some ripples in the technology stocks as well. So all things that we're keeping an eye on. So we have had a recent rotation out of the large cap growth stocks, which have been the leaders, into the smaller cap or value stocks, and also into gold as a hedge against some of those very policies we just discussed. From 1981 to 2020, we had the greatest bull market in history in US bonds. That was a period where many investment managers came up with strategies as to how to hedge or complement an equity portfolio. And the idea was you have a certain amount allocated to equities and the rest allocated to bonds, so you have your perfect complement. That worked great during the bull market in bonds, but it's worked terribly ever since August of 2020 when bonds peaked. So we maintain that it's much more intelligent to look beyond just bonds for a hedge, to look for other hedges to a possible equity decline at some point in the future, or smooth the ride. And gold is one of those asset classes that has been a much more effective hedge against equity decline than bonds. And gold will be a better hedge in a period of rising inflation like we've had since August of 2020, rising debt levels, stagflation, which is having an economic slowdown at the same time inflation remains sticky, geopolitical risk, which is certainly rising around the world, and financial repression, where when the government was taking on lots of debt but interest rates were really low, government didn't feel much pain because the interest expense was still low because rates were so low. Now that rates are closer into a normal territory, the interest expense on the government debt alone is now exceeding the entire budget for the defense department in 2024. So there's going to be a lot more attention and pressure placed on the Fed to not let interest rates get much higher so that the Treasury can keep funding the debt. That's exactly what happened after World War II. We think this could be very bullish for gold. So this is a chart that we showed before, I'm sure we'll show again, and it's a simplified way to remind ourselves that the market goes through different phases of the cycle. At each phase, different asset classes outperform. We've clearly been in what we call summertime, or when the economy has been overheated. We had big jump in inflation recently. We had the lowest unemployment rate in 60 years. We had a fantastic stock market rally. We had gold picking up. We had bonds doing poorly, all the things you'd expect when you're in the summer phase. The question is, what happens next? And a lot of that depends on the Federal Reserve Board. They've been trying to stay in summer, but by announcing that a rate cut is imminent, giving people hope that they're not going to keep rates so high that we fall back into recession, which is usually what happens. We go from summer to fall. We have a credit contraction, the economy slows. The Fed is almost always too late to lower rates because they wait till the data tells them, and by that time, too late, because when they take a move, there's a big delay before it takes effect. So it remains to be seen whether they're going to have a rate cut that's imminent and whether it's soon enough to avoid that recession and keep us in summer, or whether, like many other times in the past, it will be too late, economy will slow, and it's time to adjust portfolios. Right now, we are certainly in late summer, and the markets and the economy have benefited from the most extraordinary monetary and fiscal stimulus that our country has seen over the last few years. Another factor that we thought would be really important to talk about is when the stock market is rallying tremendously, and the rally is coming from just a handful of stocks, it's so tempting to think that all you should do is put your money in those few stocks and ride the wave. And forget about risk management, forget about diversification. That's the best way to make money. And that's what's happened in every one of the bubbles that I showed in the past. That's what many investors had done. And when it's working, it's really fun, it's really profitable, but in no time did it last forever. And so just when you think you need diversification the least is when you need diversification the most. And you can be diversified and not sacrifice decent return because of what we call positive drift. So this chart shows how over a long period of time, all these very different asset classes all make substantial money, all beat inflation over time. And you can have your cake and eat it too, so to speak. You can have a diversified portfolio, have less volatility, have less risk, and still make a decent return by being diversified across these strategies. And furthermore, we look to add value by highlighting a bit more allocation to those asset classes that can benefit from the phase of the market cycle we're in to get some added return or added risk protection. So to summarize, first point is markets, the US market in particular, the S&P 500 index, by our measure, is highly overvalued, akin to just a couple of times in history. But that doesn't mean it can't continue, and it will continue until a catalyst sparks the adjustment downward. Problem is that once a market starts heading down, often it continues down until it gets back to fair value. Because the market is so overvalued, we fear that that could be a substantial correction. We have to take that seriously. Second point is when you complement your equity portfolio with other investments, we feel very strongly that it's no longer the environment to just complement it with bonds, as so many might do, but to use other assets like gold and tips and shorter-term treasuries to hedge against rate cuts, to hedge against stagflation, geopolitical risk, or the potential for credit contraction. Then finally, for investors that have a pocket of money that they really want to keep extra safe, some turn to CDs, some turn to municipal bonds, some turn to bond indices of different natures. And we feel very strongly that a superior alternative or complement would be to recognize that we're no longer in the great bull market of bonds, and that we can achieve lots of relative safety and really focus on minimizing drawdown, but with more diversification in our conservative strategy. With that, I'll turn it back to Fritz.
Steve, thank you very much and for your insight and your comprehensive view of the global capital markets. I particularly agree with your idea that just when you think you need diversification the least is when you actually need diversification the most. I thought that was very well said. So thank you to our listeners. I want to especially thank our clients for the confidence that you have placed in our firm. We take your confidence in our firm quite seriously. And so on behalf of Steve and everyone here at 3Edge, thanks for listening.